So as gold hold, I think the main advantage is you can be very certain that you are not going to be diluted by new gold, which is coming into circulation, right? And this gives gold a high stock to flow ratio or a low inflation rate, however you wanna put it. The one is just the inverse of the other. And in other words, gold is not so valuable because there is necessarily such a limited amount of it, or such a small amount of it, I should say. There are rare earths which are much less of them are available, but that doesn't mean necessarily that they are worth more. But gold is so interesting as a store of value because its amount is so constant. So you can really know it's basically the same amounts going around this year as it will be next year. But not 100%, but 1.5 percentage points.
Hello and welcome to the Get Stacked Investment Podcast, where we delve into the exciting new world of return stacking. Join us as we break down complex financial concepts into accessible insights, speak with leading experts in the space, and analyze real-world applications for return stacking. Get Stacked is here to help you break out of the traditional portfolio construction mold and get you to start thinking differently about the path to successful investing.
Corey Hofstein is the co-founder and chief investment officer of Newfound Research, and Rodrigo Gordillo is the president and portfolio manager of Resolve Asset Management Global. Due to industry regulation, we will not discuss any funds managed or sub-advised by these firms on the podcast. All opinions expressed by podcast participants are solely their own opinion and do not reflect the opinion of neither Newfound Research or Resolve Asset Management Global. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Clients of these firms may maintain positions and securities discussed in this podcast. For more information, visit returnstack.com.
We're thrilled to welcome Mark Valek, partner at Incrementum AG and co-author of the highly respected In Gold We Trust report. Often called the Gold Investor's Bible, Mark brings decades of experience in macro investing, asset allocation, with a unique focus on the intersection of gold and monetary policy, as well as systemic risk. This year's 2025 edition is entitled The Big Long, and it explores everything from fiscal dominance to central bank trust to gold's evolving role as a reserve asset, and even Bitcoin's growing role here. So there's also a reimagining of the 60-40 portfolio, with the role of gold and Bitcoin in the new regime playing an expanded role. Great, Mark, it's great to have you with us. And, from the perspective of the paper, can you elaborate on the big long?
Thanks for having me, gentlemen. It's a pleasure. Yeah, we, as you already mentioned, write this In Gold We Trust report on an annual basis, and every year we've been giving the report a leitmotif, and this year's leitmotif, as you said, was the big long, which is obviously a little bit of a play on the movie The Big Short, in which basically showed a lot of the hedge fund managers back then betting on the housing crisis, basically. And this is a little bit of the inverse, the idea that actually a long position on the gold is probably going to, in our view, at least be a very profitable trade, if you want to look at like that. But it is actually, in our view, obviously much more than just a trade. It is like a systemic rediscovery of gold as a reserve asset. I'd put it in this kind of terms. Because of everything we've been seeing in the last years, actually, the dollar-based system is being eroded. It's the trust in it is slowly being eroded because of a lot of things which have been happening, and this is really our message to investors, since we are also asked a lot of times, well, gold price has risen so much. What should we do? It's probably at the end of its road. And if you look at our cover, the road is relatively long still, but it's also a little bit bumpy. It's not like a straight road. It's not a highway. It's nothing that we are expecting. But what we want to point out is we do think that this bull market has a lot of ways to go, because, as I said, in our view, the monetarization, which is a difficult term, we can talk about that perhaps, but the rediscovery of gold as an asset in systemically has started in our view.
And how are you observing that?
Well, I'd say the most evident or obvious indication for that is if one looks at central banks. So we know that central banks have been buying gold and accumulating gold actually already since 2009 in a relatively slower pace when it comes to the years 2009 to 2022. I think the average accumulation was somewhere between 300 to 400 tons during these years. But in 2022, something was kicking in. If one looks at the purchases, they blew off to over 1,000 tons a year. So basically 3x, and they have been in this ballpark since consistently the last 3 years. So probably the pivotal occurrence, what actually happened was, in our view at least, the sanctioning of Russian assets in this conflict, when it came to the war in Russia. Obviously the world saw this, because I mean, if you take the standard wisdom, and even I think it's part of the CFA body, if you take the CFA exam, you get to learn what is the riskiest asset, and you have to actually tick off the box. US Treasury are the riskiest asset. For a lot of people in the world, it became evident that they are not riskless anymore. So if you're politically perhaps not in the best friend of the US, then perhaps counterparty risks are, you should reevaluate your counterparty risk. And I think the world is been doing this. And again, it shows up in central bank purchases first and foremost.
So Mark, I just popped up one of your charts here. And so that's the kind of big jump since the Ukraine invasion that you're alluding to, right? And do we think that's basically because of the sanctions to Russia and the fiscal misuse of the United States and other central
Sure,
banks?
I mean, yeah, I guess it's not this only factor, but it's I think that the jump does have to do with the sanctions. I would argue that. And I mean, as one can see, I think the first moment of distrust was when the system was questioned. Obviously, was around the GFC, or in the aftermath of the great financial crisis, 2009, 2010. Back then, counterparty risk also obviously became a topic, since we had some banks failing at first, at least. So this was, I think, the first bigger dent into this the dollar-centric monetary system, which has been going on since you can argue 71, 73, wherever you want to put the date. But really coming from a very unique situation. If one goes back further, like if one looks at the 1990s, the US was the only game in town when it comes to geopolitics. It was also called the only superpower, and it was there was basically no rivalry going on. I mean, Soviet Union had broken down in 91. And the US had a great run in the 90s, even had some surpluses from the fiscal side at the end of the 90s. So the dollar was really king at the end of the 90s, no competitor. And gold was flat. Nobody had interest in gold. It was also basically where you had the lows in the price. And a lot of things have changed since then. I mean,
Mhm.
fiscally and also geopolitically. Yeah.
Yeah, it's incredible to see that in post '08, you get the rise in demand for central bank purchases. It's around the same time that Bitcoin launches as well as part of that mistrust, and it's big jump, consistent growth in purchases, and then another massive jump in the last 3 years. So
Well, it
pretty
really was a
impressive.
watershed moment. I mean, we've had conflicts globally, but no one has ever seized the reserve asset of another nation during a conflict. And that moment in time caused everyone to sort of stop and say, well, if the US Treasury is the reserve asset, they know where all the treasuries are held because they're the issuer of those assets. And if we do something that is not agreed to or isn't liked by the US, then all of a sudden our treasury becomes at risk for confiscation. And gold is that one asset where it's not a counterparty risk to anybody else. When you hold a bar of gold, it is yours. Now, paper gold's another topic, but it's a pretty significant watershed moment. And then you've got the fiscal dominance following that up, Mark. And I wonder if you've got some comments on that, or thinking into how this bleeds into other areas for demands for gold. And then obviously, I'd love you to touch on the initial conditions we have, i.e., where are we starting from an allocation perspective across portfolios generally?
Yeah, so I'd like to add to the counterparty aspect. I mean, this is not as relevant for every investor. As I said, I mean, probably the 800 gorilla pound gorilla in the room is China, right? So I mean, it's no secret that China and the US have this geopolitical rivalry, and China has huge surpluses. So this is a big topic which going very lively debated today in policy efforts by the Trump administration. But that's nothing new. So that has been going on. But I just wanted to say, for US-based investors, the counterparty risk actually it hasn't been imminent, and I'd argue it's still not imminent. So it's very crucial to whom you speak, right? And I think also as a part of this reality, US financial institutions who still own the largest pools of capital and therefore are very important for price discovery for all kind of markets, but gold being one of them. They haven't been participating in this rally, and they I think this is also very important to explain. That's a very good chart that you're pulling up to explain this discrepancy between all kind of performance of say, for instance, what we call performance gold, what we include gold miners, but also silver. Both of these assets were actually relatively weren't performing that well in the recent bull market. Why? Because the bull market has been a central bank driven bull market, and typically silver, but also mining equities are marginally bought by Western financial investors, and they again haven't participated yet. I think that's just noteworthy fact. And referring to this graph, this is the new gold playbook, what we called it last year, our last year's leitmotif. We wanted to highlight that actually this relationship between the real interest rates, and in this case, it's also the ETF holdings. The charts look very similar. Actually, has broken, right? So ETF holders, which are ETF purchasers, are typically in the West, are typically Western financial institutions, and they always were, the last 2 decades at least, have been the marginal buyer of gold. And I think this correlation is quite evidently seen here. Even though, that's quite interesting, I think, even though the total amount of gold they hold, and we see this on the left-hand scale, isn't that big, because we have estimated amount of total above ground stock of 220,000 tons. and they've been holding something like 2,000 tons, right? So that's not a huge amount, but at the margin, it was enough, obviously, to move the price. And again, this goes back to my argument. They didn't see any need, if you look at the right hand of the chart, any need to increase their gold holdings. Actually, they sold when the interest rates started to rise again, whereas the price just started to soar exactly then. And so again, I think this is quite a good confirmation of our argument why what has happened. It's been a central bank induced bull market, which I think explains why performance gold, as we call it, has lagged, and which also I think one can conclude, if Western investors join the party, then we're going to see performance gold to make up some underperformance, and I think this actually may have started during the last weeks.
Yeah, well, when you look at there's a pie chart here that I want to present quickly. When you look at the existing holdings for gold, I thought this chart was illuminating, right? Since the beginning of my career, as I met Mike, whenever we walk into a room of financial professionals, we ask how much of their holdings for clients are in gold, and it's a shocking amount that says zero. And this chart just kind of shows it here. You got gold and precious metals at around 1% versus all other asset classes. So that cohort has not woken up to the utility of gold so far. It's fascinating to me, but you're starting to see some pickup, just not at the same rate as the gold price.
I would say that we're starting to see them pick up, and just evidenced by the way the underlying gold equities have been playing. As Mark mentioned, that tends to be a lot of North American participants will jump into that, and it sort of flows down. The price of gold is up, and then it stays up, and then you have to go through the discounted cash flow analysis for gold mines, see how much they've sold forward, where they're flat on it. So there's this lag period between where you actually get some interesting cash flows, and now you're seeing those growth numbers in some gold stocks too that are pretty substantial, largely based on the gold price coming through in their profits. But you're seeing the capital flow that way too. Just if you look at GDX or GDXJ, the ETFs in North America that represent them, you see some outperformance finally in the last month or two, I think. So it does seem like your thesis is on point, Mark, that the North Americans are joining the party slowly but surely. And I think you mentioned in the report you feel we're in middle innings on this in the sense of a baseball analogy.
Yeah, I mean, this is obviously always a very tricky thing to estimate the bull market's evolution. But I think one can make the argument that that there's obviously we're not at the beginning. That is also clear. So if we don't think that we're at the end, so I guess that leaves us that we're somewhere in the middle, right? But obviously, I mean, we've been talking about this rediscovery of gold as an asset class, which has been much more prominent at the level of central banks. Now it's slowly perhaps starting in the Western financial scenes again. But I think what is still kind of an unknown, and you actually asked me about that, Mike, just before the question before. What's going to happen with the fiscal situation, right? Fiscal dominance, if you want to call it like that, and we really don't know where this is heading. I mean, it doesn't really look as if it would change anytime soon. We had, I have to say, a brief moment of reconsideration, or let's put it that way, of looking at what's going to happen with Doge, and you've already put up the slide here. So one I think can say about the administration what one wants, but what they did do for the first time, I think, ever, or at least the last 50 years, they actually addressed the point of the unsustainability of the fiscal situation. And that is, I think, quite significant actually, because I mean, if you just think, last Treasury Secretary Janet Yellen just said, no, everything is fine and no problems, nothing to see here, and now the officials actually pointed out very clearly, or at least they did so. That was quite an interesting moment, and I'd say, I mean, at the end of the day, one has to think about why is the gold price rising at all. And the gold price is rising because there is more inflation being produced in terms of more monetary units, monetary inflation, in order to basically reflate the economy or inflate away the debt, right? This is like the typical structure of basically also this debt-based monetary system. One can argue it's actually by design like that, right? And so I think the fundamental question which one has to ask oneself is the fiscal path on a sustainable, is the fiscal path sustainable or not? And obviously it hasn't been sustainable for the last decades, but as I just said, no, they were at least addressing this point and talking about changing the path, but it doesn't look like as if they would be close to substantially change the path. And as long as we don't see a change in this momentum, I think we really don't know how long the bull market for gold actually can last, right? So there are really a lot of factors which we do not know about the future, but we can say these factors are steady right now, and that's why we assume that there's still a lot of upside going
I mean,
on.
it is fascinating to have watched the ups and downs of the promises, the hope, and now with the big, beautiful bill, seeing how much more spending and continuation of the past there's been. I think, what was it, that Elon's line? The bill can be big, it can be beautiful, but it can't be both. I think that's bang on, right? And I think it's it's a very big bill, and I think the hope for the administration is really unlocking efficiency through cheap energy. But even as you look at the bill and explore what they've done in terms of solar and the like, they're making it more difficult to have cheap energy in the United States, with the exception of trying to drill, baby, drill, which is yet to be seen how they're going to accomplish that. If they're able to unlock that, then I think all bets are off, and who knows what's going to happen to gold, right? If they unlock a ton of efficiency, and I think everything has to be, most of efficiencies can be driven by cheap energy costs, but that is a unlikely scenario in my view. And it's certainly going austerity is not going to be something that the administration is going to do. Right?
No,
I agree.
we have to print. And this quantitative tightening has been ongoing of late. They haven't even started to start to roll some of the debt and quantitatively ease. And we have this in the face of quantitative tightening. We have a very strong gold price. I think the other thing in the real current domain is people will say, or have said, it's up a lot. Well, that's fair. But we're going through a moment of consolidation. It is consolidating those gains. And if you're someone who's been thinking about allocating, this is the time to start actually giving yourself some time to allocate to an asset as it kind of digests a little bit of the gains it's had over the last year or so. I just think it's a bit of a sweet spot where you're still early enough where you can garner the gains. And we often approach it, Mark, from the perspective of the unique asset class to the portfolio. Right, gold just brings such a unique orthogonal angle to a portfolio of sort of more commonly accepted assets. It just always makes a lot of sense. And how you accommodate it and get in the portfolio, that's a bit of a long story, but it generally always makes sense to have some gold. And I just feel like that we're going through that three phases of truth. If you go back to I think even Gandhi said this, right? Truth passes through three stages. First, it's ridiculed. Second, it's violently opposed. And then third, it's self-evident. And I think the ridicule was sort of back a ways. where people, why would you ever buy gold in that period where the U.S. dominance was so strong, U.S. dollar was very worthwhile. Then now it's been through this. It goes through this opposition. Why would I hold it? What are the reasons? And then eventually it's going to be self-evident, but then it's going to be all priced in. When it's self-evident that it should be 10 or 15 or 20% of your portfolio, the price is going to be pretty high.
Yeah.
So Mark, why don't you walk us through this chart here? And there's this chart and the one next that talks about the path dependency. But tell us about how you guys are thinking about the different scenarios.
Well, so I mean, as already perhaps may have become clear a little bit of, from our conversation, what we do like is thinking in longer terms, because I think it's very difficult to evaluate something in the short term. Especially, I mean, everybody wants to know where will the gold price go tomorrow to the end of the year. But I think it's more realistic to get some kind of a feeling in the longer term, because these longer term trends, as we already discussed a little bit, to us seem very firmly be in place, and therefore we basically 5 years ago made some kind of long-term predictions, or at least we tried to quantify a model where we calculated different scenarios and then did a weighting of these kind of scenarios. We assessed how likely are each of those scenarios, and our basically the average scenario brought us for a 10-year time horizon for the year 2030, at the end of the decade, to a probable gold price of $4,800, and that was, as I said, 5 years ago, when the gold price was at 1,700. That back then sounded quite, I think, outrageous for some people, even though actually the average return, the compounded rate of return, wasn't extremely high. I mean, what we looked at during these calculations was actually the decades, the historical decades of the gold price, and we only have basically from 1970 to see these different decades. We had actually two good decades, which were the 70s, obviously, which was the greatest decade, and the 2000s, which was also quite good decades for the gold price. And during the other decades, it basically had sideward markets or bear market in the case of the 80s. But so in the long term, I mean, so we calculated, or we estimated the rate of the monetary supply growth. That was one factor, and also the other factor was like the implicit coverage ratio of gold. So how high, basically, to what extent will gold be basically covering the monetary base. And that's a function of two things, again, of the amount of gold the central bank has, and the gold price, if you market to market. That's how we calculated it, at least. And yeah, and we as I said, we had different scenarios, and the one thing, so the average scenario was 4,800, and we are now above basically the path to 4,800. We were below the path, but now we are above the path. And so this is the dark blue line, which you can see. This is the path which it would need to take to get there. And we also, I mean, one of these scenarios was an inflationary scenario, and because, I mean, as I said, the 70s were a very good environment for the gold price due to inflation / stagflation. And if we see such a scenario once more in this decade, we back then said, well, then the target will be considerably higher, something like $8,900 in that range. And what's been interesting in that regard is, obviously, we saw quite significant inflation in the first half of this decade, but the problem, at least statistically speaking, resolved or wasn't so bad in the last year. So inflation rates at least came down. Obviously, that doesn't mean that prices came down; just the rate of increase of these prices came down. But it was at one point quite significant. I think close to 10%, even in the US, something like 8-9% or so in this range. But that came down to 3% range again. So in our view, to really, and a similar thing actually happened in the 70s. We had one wave in the first half and the second inflation wave in the second half of the 70s. So in order to qualify as an inflationary decade, I guess we would need a second wave of inflation, and I think that's totally possible. In fact, it's quite likely in our view. And if we will have a second wave of inflation in the second half of this decade, I think this decade will go down as inflationary decade, even though right now it's not perceived as this yet. And then we feel very confident with our bullish price scenario at close to $9,000. But we will see if it really kicks in.
Yeah, because look, it's again, whether that scenario ends up happening, I think it's important for people to recognize that predicting the near future is really tough. And so I think a lot of people see these lofty predictions and then they invest, and then a month later, when there's a 20% correction, they say, "I told you so," or "You got me into this at the wrong time." So I think it's important to show this chart here where you kind of describe what the different kind of corrections might be along the way. It's not a straight shot. So walk us through this chart.
Right. So we also looked at the max drawdowns during each of these decades, especially during the bullish decades, because our premise is that we are in a bull market, obviously, and even bull markets have drawdowns. And during the last two bullish decades, we had drawdowns between 20 and 30 percentage points. I think 3 or 4 times more than 20%, and in one case in the 70s, at one point actually 50% drawdown, which is quite severe. Can argue if that actually then ended the bull market and the new one started in the second half. That's a statistical question how you want to define the bull market. But in any case, the point being 20 percentage points of drawdown, definitely something which one can and should expect, even if one is bullish. And just to basically give investors some kind of an overview where that would put us from the last all-time high, that would be $2,800 basically if we fall 20 percentage points from the last all-time high, which is totally possible. But again, we don't know if it does fall that low. So the one strategy which I think in any case makes sense probably is to average in and to average out, by the way, as well. So averaging in will help you to get a little bit of a better average price. And I think the other help is psychological, because if you just like pinpoint your entry point on one specific point in time, you always it's kind of, if the market doesn't go the way you want, you always will question this decision. But if you kept some powder and average in, you actually have a lot of, in both cases, if it rises, well, you didn't do it wrong, right? Because you put something in already. But if it falls, you have enough power to average down your price. So that really, I think, helps you to be more comfortable with the position to some extent.
Also, I think helps build intuition for allocators and investors who may not have had an allocation to gold, which is not, given the facts we know from the report, 1% of assets held by asset owners are in gold. So not a lot of people have intuition for how this asset class functions in different ways when compared to, let's say, stocks and bonds, and how it responds to inflation and potentially deflation. And so as an allocator, I think I echo Mark's advice there. Take your time, make an allocation, and then rebalance that allocation. And also maybe you sin a little because you feel you're in a bit more of a bull market and you let that allocation run up, gives you a profit cushion and allows you to add more at a potential time down the road to continue to complement those traditional asset classes that people are so over invested in, from stocks and bonds to even private equity, private credit to some degree.
One of the things that with regard to allocating and speaking with allocators and contemplating gold versus other traditional asset classes is the lack of yield that gold has, right? From a fundamental perspective, professional allocators like the dividend yield. We've learned the discount value mechanism. We are getting yields on bonds and cash, but gold doesn't offer any of that. And so how should we help allocators think about gold as a diversifier, gold as an asset class, given that it doesn't offer much on cash flows? In fact, it probably costs a little in terms of storing and carry costs.
Right. I mean, this is, I think, a very essential question. And this basically to understand at least our view, but I think a lot of people share this view. One really needs to dive into the monetary system and at the end of the day, answer the question, what is money? And that is a simple question, but it's I think this has no simple answer. But if one looks at the Austrian perspective, Austrian School of Economics perspective, I mean, money basically evolves or evolved or often evolves always again in an economy which where you have the division of labor, right? So you need the demand for medium of exchange occurs is once the economy produces supply output was greater than its consumption. So you basically have the need to store some of your excess production, right? And you need a medium of exchange, which basically keeps account of these excess production excesses. And depending, I mean, it's really interesting, and I can really just encourage everybody to read Alan Greenspan's essay, which is short but very to the point, Gold and Economic Freedom. You can just Google it. It's a really great essay from Alan Greenspan, which he wrote in 1967, I think, where he basically describes also this evolution of money in different stages. Depends how much surplus you produce as an economy. You need a more durable money, right? So in a decentral evolutionary market process, actually, all over the world, the more sophisticated the economies became, the more excess savings they produced. They had a demand for a more durable medium of exchange because you had all kinds of monies all the time, and with nobody legislating it that way in a market in a competition process, basically. Precious metals won the race, right? Due to their characteristics, and we can talk a lot about the different angles of that. But perhaps the most important and oftentimes most overlooked factor is the stable stock to flow ratio, especially for gold. This is true, and the stock to flow ratio basically is the inverse of the inflation rate or the growth rate of the gold. So the stock is all gold stock, above ground stock. That would be the 220,000 tons of gold, which I referred to, and the flow would be 3,000 tons, 3,500 tons roughly, which is being produced every year. And if you divide these two numbers, you get like 1.5 percentage points inflation rate, if you want. So this is So as a gold holder, I think the main advantage is you can be very certain that you are not going to be diluted by new gold, which is coming into circulation, right? And this gives gold a high stock to flow ratio or a low inflation rate, however you wanna put it. The one is just the inverse of the other. And in other words, gold is not so valuable because there is necessarily such a limited amount of it, or such a small amount of it, I should say. There are rare earths which are much less of them are available, but that doesn't mean necessarily that they are worth more. But gold is so interesting as a store of value because its amount is so constant. So you can really know it's basically the same amounts going around this year as it will be next year, but not 100%, but 1.5 percentage points. And this rate was it has been extremely stable over the last 150 years, where we have the data. Going back further, it's a little bit difficult to assess the exact data, but most of the gold has been produced recently, basically the last 100 years, because even 1.5 percentage points adds up, and we had, I think, 30,000 tons turn of last century, 1900, and now we've got 200,000 tons. So it's most of the tons the gold has been produced now, but still it's a very constant amount. And this is the unique thing. So this makes it a good store of value, and this makes it the good money, basically, right? And that's why actually it ascended to money, and it is no one else's liability, right? I mean, we talked about that as well. And this again, I think, is a very important prerequisite for real money. You want money to be an asset. You want the money not to be another man's liability. And this is why gold has such great characteristics for money. Yeah, and this is also the reason now, going back to your initial question, why it actually doesn't have to pay interest. Because if you think about the alternative investments, and actually one shouldn't, in our view at least, directly compare gold as money, or as a non-fiat money's store of value, with productive assets like bonds or stocks. But in these cases, if you lend money to a government, as we also discussed already, there is always risk involved. There's a counterparty risk involved. If you give some money to an entrepreneur to invest in a stock, there's a risk involved. That's why there is a justification for a compensation for this kind of risk. But if you basically don't give any, if you don't have any counterparty risk, actually you can make the argument you don't actually are entitled for yield, right? If you have the cash in your pocket, you also don't get any interest. By the way, you only get it if you put it on the banks, and then you already are taking risk again, right?
And a
So
lower yield
gold,
most of the time if you just put it in
yeah,
banks, right?
yeah, correct. So gold is money. I think gold is the natural money, or it has very good characteristics of money. And that's the reason why central banks hold it, because at the end of the day, and it's also a great Greenspan quote, in times of extremism, gold will always be accepted. And they know to recapitalize the system, they need an asset which is no one else's liability, which is not inflatable. And that's why they hold it, because it's the real money.
And so shifting a little bit to the new gold, Bitcoin, I know you guys did some work on that. Can you tell us what you guys think about Bitcoin and how it relates to the characteristics of gold and how it doesn't?
Right. I mean, it's funny because gold is an emotional topic because of these topics which we already have been talking about, which these concepts are not so widely, I think, thought of in the financial world. And the monetary system also not such a big topic of typical investor. And now with Bitcoin, this is even, in my experience at least, more controversial, more emotional when it comes to Bitcoin relative to gold even. So I think that's a good transition to Bitcoin, because building on what I just laid out, Bitcoin was basically, I think, designed obviously by whoever with a lot of knowledge about the evolution of money. So they were very conscious of the problem, obviously, of this debt-based monetary system. But they also knew about gold's advantages, but they actually tried to improve gold, even in the sense that there is not even this 1.5 percentage points inflation, but at the end of the day, zero inflation. So I think this is obviously a very big part of Bitcoin's appeal. It's absolute scarcity. And that is a concept which one really, I think, has to think about harder than one may think initially, because it's really a new concept for humans. There hasn't been an asset which has been absolute scarce, at least not a fungible one. Obviously, we have art pieces, unique art pieces, where there is only one Mona Lisa and so on. But you definitely can't use Mona Lisa as money, because there is only one, right? You need a fungible money to have to tick off all the boxes for the requirement of money. So Bitcoin brings along fungibility, but it brings along absolute scarcity also. And this is the first time what we've been confronted with such an asset, which is a digital asset, which again makes it difficult for a lot of people to wrap their heads around it. You cannot touch it, so it's perhaps less intuitive as gold, because if you do touch this gold, you get some kind of a sense of value. It has something mystical to it. I think for most people that's the case. But you have none of that with Bitcoin. So it's really the scarcity argument, obviously, which is important. Also one can, I mean, we've done all kind of comparison between gold and Bitcoin. Obviously, we're not the only ones, and Bitcoin has advantages relative to gold as money. I would definitely say that. But it also has disadvantages. But the matter of the fact is, it has been discovered also as an alternative store of value, and I think one can best compare it with gold. It's not the perfect comparison, but people who invest in Bitcoin have similar motivations as people who invest in gold.
And the design of Bitcoin has, similar design features as gold. I think that's the idea, was to make it a gold alternative, just simply by how the stock to flow works, how the fact that it's going to be scarce, and then after that, it was a network effect, whether it was going to be adoption. I mean, why gold versus any other metal historically? We can talk about that, but the reality is that society has accepted gold as a medium of exchange, as a store of value. Every major economy has some gold. Most individuals, in one way or another, are backed to buy gold because they live in the country that owns gold. And now we have Bitcoin that has a similar characteristic. The question is, what are the blind spots of both gold and Bitcoin? And I think they generally tend to complement each other. It's an interesting use case here. So there's as Bitcoin becomes more and more adoptive, though, what are you guys trying to tell us here with this chart? In regards to
so exactly. So how to measure gold, and we measure that in a monetary sense. And now building of our gold model, we this year for the first time integrated like a valuation model relative to gold, because as I said, both assets are used for similar use cases. Obviously, there's a store of value or speculation, however you want to put it. But what we are seeing here is basically the market capitalization of all global brown stock, so gold. These 220,000 tons priced at market, and we are somewhere at 19 trillion. About 22 trillion dollars currently market cap. So that would be the golden area representing the market capitalization on the left-hand side. And we are somewhere about at over $2 trillion all the Bitcoin market capitalization. So roughly a ratio of 1 to 10, or in other words, all world's gold is worth 10 times as much as all Bitcoin which are currently produced. And then in both cases, in Bitcoin's case, by the way, we know more exactly how the exact supply will be in the future. But in gold's case, we know it pretty good. We estimated the gold exploration of the next 5 years, plus our price targets of in the conservative range. It's, as I said, 4,900. Let's call it $5,000. That would bring gold's market cap up to 38 trillion. So that's almost a 2x still from here, not quite. And Bitcoin, if one looks at the relative at the ratio, basically, we can see obviously that the market cap has been growing much faster in Bitcoin, but it also has been growing much more volatile. So the ratio has been coming from zero basically and moving up to 10 percentage points roughly. With a lot of drawdowns, and we want to point out that the right-hand scale is logarithmic, which basically the drawdowns don't seem so significant, but there was quite significant, obviously. But I think the logarithmic scale shows this increase nicely, and also it shows a small decrease of this increase, right? So the rate of return is being far greater with Bitcoin, but it has been coming down slightly over the years, and we basically extrapolated this trend. So our estimation is our premise is that Bitcoin will keep growing faster than gold. We think gold will keep growing, Bitcoin will keep growing faster, and I mean, this is a numbers game, to be honest, but we picked a number of 50 percentage points. So we could imagine that at the end of the decade, coming from 10 percentage points market cap, where we're currently roughly, we may end at 50 percentage points market cap in terms of Bitcoin to gold market cap ratio, right? And that brings you to quite high numbers. I mean, this is also this table we included for everybody to plug in their own expectations. But with these two numbers, so 50 percentage points market cap and a price of 5,000 at the end of the decade, that leads you to very high six-digit prices in 5 years' time. Which, yeah, which is bullish, which is optimistic. I would like to add here, but we don't think that it's. We think it's achievable.
Mm-hmm.
It is achievable, in fact, if the ongoing trends remain intact, then we will land in such a kind of a range.
Yeah, I mean, it's an interesting way that you guys have modeled this up. It's certainly, if there is continued debasement, again, because of the way that Bitcoin has been designed, it also makes sense that we're going to get more and more adoption. We're seeing institutional adoption now. BlackRock has something that's adjustable for the traditional finance individual. So it's becoming easier to accept. It almost feels like people are talking about Bitcoin more than they're talking about gold. So it also tracks that it'll probably get higher adoption faster, right?
Yeah.
From a lower base rate.
Yeah.
what I always can witness is that these two assets are nearly all the time being mentioned in the same discussion, right? I mean, that's really evident, and that's also, I mean, we wrote 2019 gold and Bitcoin stronger together, and that is also what we do as an asset managers management company. In 2020, we launched our combined gold and Bitcoin product because we were of the opinion that in combination these two assets have a better risk return profile, and I mean, so far we've been I think spot on with that idea, and also with with the track record of the assets and of the combination, I think also confirms this thesis so far. So we have now a hard asset or sound money, however you want to put it, bucket, which I think will more become kind of a building block of people's portfolio. You can do it on a single level where you can basically adjust your the composition of this hard asset block as you see fit, or you can do it in a combined way. That's what we offer basically, where we do the rebalancing for our clients, where one can also have the advantage of an overlay, derivative overlay, which then, by the way, makes it possible to earn some yield. So we solve the yield problem also in that regard. But yeah, so I think this is going into this direction. The last sentence in this regard, people like Ray Dalio, who I think are very highly regarded, especially among asset managers, or to me, I think he represents like the king of strategic asset allocation. I mean, he's referred as hedge fund manager, but I think the real USP was the combination, the structuring of the portfolios at Bridgewater, what they do. Anyway, he also, I think 2 or 3 years by now ago, said, "I like my gold with sprinkles of Bitcoin on it." So he also sees these two assets as in one bucket. At least that's what I took away from that comment. And I guess this is slowly but steadily moving into this kind of direction.
Very
I
interesting.
like that. I like that. We've got maybe 5 minutes left. Do you want to talk a little bit about how you guys reimagined the 60/40 through the context of a new regime and gold and silver stocks? Or is there another topic that you'd like to hit?
Happy to do so. No, happy to do so. The new 60/40 portfolio is something we presented last year, actually, in 2024. And so you know about the classical 60/40 portfolio, multi-asset portfolio, where you have this 60% equity, 40% bonds, or some kind of variation thereof. And that, I think, does make sense from a risk-adjusted perspective, but especially during a time horizon where you have falling interest rates or disinflation, which basically comes with each other, and because you have typically the bond part of the allocation which profits when you go into recession, and the equities when you have growth. So you've got slightly negative correlation between these assets in general, and so and both of them produce yield. So if you add them up, you have a superior risk-adjusted return profile, and that's what's mostly about in asset management, right? But we are of the opinion that basically, since we see that the interest rate trajectory is we hit zero, right? And now we are of the opinion that we're rather seeing a bull market in interest rates, in other words, a bear market in bonds. Something again similar maybe to the 70s, and that's awful for this combination. We saw that in 2022 already, when you had a year where stocks and bonds combined actually really had a really bad performance because both assets fell. You had a positive correlation in a falling market. That's not what you want to have. And I think that was an indication for more of those similar years to come potentially, especially again if we see second inflation wave, then these kind of portfolios I think are very very much endangered. So that makes an argument to basically reconsider, especially the bond component of this of this 60/40 portfolio, which we did, and find substitutes for bonds. And I think this is going on, especially with gold. So gold, I think, to some extent, has been still very slowly, especially in this institutional level, not at all yet, I'd say, but to some extent being substituted, and we see this as a trend. And also another argument in favor of gold, I think, I mean, typically if you have a few percentage points at all at maximum in your conventional multi-asset portfolio, I think one can make the argument also from a risk point of view, since it is so unique, the asset, and it doesn't have a counterparty risk. If one takes into consideration the whole return distribution, you don't actually have like kind of a black swan event with gold. Obviously, the price can fall, but you don't have a sanctioning event where you're something that. There, by the way, I also think it's advantageous to Bitcoin. You have potentially some technical problems, which I think the risk is pretty low also, but I think I'd say it's not zero, right? So you have in all kind of different asset classes, but especially in bonds, you have like left end probability, which would be very bad if that happens, and you don't have that with gold. And I think also from that perspective, it gives you a great argument to increase your gold portfolio significantly, because you don't occur some kind of black swan event with the gold generally. So we tried to structure a new 60/40 portfolio accordingly, and we increased. So we had in the 60%, what is typically the equity portion, we put in all the bonds and all the equities in 60%, so that we ended up with 45% equities and only 15% bonds, which brings it to 60. That's the 60%. And the 40% in our new 60/40% portfolio is hard assets, basically non-inflatable assets. So we've got a chunk of security gold in there, but we've got some performance gold, as I said, that would be mining equities in there. We've got a small slice of commodities in there, and also a small slice of Bitcoin in there. So we come up with a hard asset block of 40%, and we are of the opinion that this is going to outperform the conventional 60/40 portfolio, which it has, by the way, since 2024, but we'll see how that ends up in a few years' time.
Yeah, so I think I just found it. Just to quickly share with everybody here, a 60/40 into that combination here, you have 45% stocks, 15% bonds, 50% of safe haven gold, 10% of performance gold. So again, performance gold is the idea of miners, silver, etc., right? 10% of traditional commodities and 5% Bitcoin. So for everybody, this is in the In Gold We Trust playbook.
Okay. Right. So this is, I'd say, an extremely unconventional allocation currently, but I mean it's not so far from my personal allocation. So we really, I mean, practice what we preach, and I think it's so far for this decade, this has been doing very well. And as I said, I think the dynamics are in place for this portfolio to keep outperforming. There are risks obviously involved with every asset class, with every strategy, but we are quite convinced that that's a good way to go.
Given the regime, sounds like a sound plan.
Yeah. Well, thank you, Mark. Really appreciate your insights today. Very insightful. love, this is the first time I've actually read this report. So it provides a lot of insight on all things precious metals and Bitcoin. I recommend everybody download the chart book or read the paper. But just before we sign off, tell the audience where people can find you, what you guys do and offer. You mentioned fund and investment opportunities. So tell us a bit more about that.
Yeah, right. So basically, our fund business can be found at Incrementum.li. That's our homepage here in Liechtenstein. And we have our A Gold We Trust report at In Gold We Trust, all one word, .report. And everybody can subscribe, can download without subscription. We keep it very open. Personally, we have a Twitter feed, In Gold We Trust Twitter feed, which is quite active. So we can be found on these sources. And yeah, if anybody has question, can drop me an email.
Fantastic.
Thank you, Mark. Really appreciate your time and the hard work that you guys put in on this. We'll hopefully have you back again when gold hits 5,000. But if anybody has any questions, you can go to those two websites and contact Mark and team directly. Thanks again for your time.
Thank you. Thanks for the invitation. Have a great day.
Thanks all.
If you're enjoying the podcast, please consider heading over to your favorite podcast platform and leaving us a rating or review and sharing us with friends or on social media. It helps new people find us and helps us grow. Finally, if you'd like to learn more about our extensive research on the concept of return stacking, please do head over to returnstack.com.